Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and this week I'm joined by Zach's Director of Research, Shiraz Mian, to take a look again at the upcoming earnings season. I usually have Shiraz on almost every quarter to talk about what's going on, and last quarter I remember we thought it was going to be one of the most important earnings seasons in quite some time, but we were wrong. Maybe this quarter is now going to be one of the most important earnings season. A lot of people think Q2 is going to be terrible, Shiraz. That's all I'm hearing, like, oh, it's going to be awful. But yet there's not that many warnings coming through, at least not what I expected there to be. There's the usual retailers and some of those guys warning, but that doesn't seem too bad. But maybe you're going to tell me otherwise. And it just doesn't seem like it's all going to be doom and gloom for this quarter, but maybe it will be baked into that guidance that we're going to get. So what does it look like out there on the S&P 500, Shiraz?
Yes, you're absolutely right, Tracy. There's no doom and gloom, either in the pre-announcements or even in the estimates and the revisions that the analysts are providing us. So a lot will be riding on how these management teams frame what they see in their businesses, and this could be the quarter when expectations and the really negative outlook that a growing segment of the market appears to be kind of banking on, that comes to fruition. I'm not sure. It's not in the data yet, but if it's in the cards, if we are heading into a recession, a big F, obviously, then we have to start seeing that in data. It's not in the macroeconomic data, and it's not in the corporate earnings data, at least not yet.
Okay, so what are the industries that we should be looking for as like the ones who will send out the warning then? I mean, we lead off with the banks always, but it can't be the banks, is it, who's going to sound the alarm?
So the banks touch practically all aspects of the economy on the business side as well as the household side. So we have some really huge banks, and these management teams do discuss what they see in credit quality and all of those related terms. So at the start of the earnings season, for these guys, the banks, the JP Morgans of the world, to frame the conversation as to what they see in their own expenses, in loan demands, and then on the credit quality front. And I think that will then be the conversation will get confirmed or otherwise as we get into the rest of the earnings season.
Okay. Should we kind of ignore some of the banks that will warn because mortgage demand has fallen through the floor? Like we've already heard from Wells Fargo a couple days ago that, their mortgage business is way, way down. So they were essentially warning on that aspect, but they are one of the biggest on the mortgage side. Should we just kind of acknowledge that the mortgage area is going to be bad with those rates having risen? Nobody's doing any refis anymore, that kind of thing, and look at other areas that they're going to be talking about, like the hurricane that's approaching or whatever it was that Jamie Dimon from JP Morgan said. Should we be looking, in other areas other than mortgages?
Yes, I think it's not so much the housing related part of banking that's in question at this stage. The market, and we are seeing some of that in estimates as well. So the areas on the banking front where we know there are already weakness and problems, in addition to mortgages, the investment banking business has really fallen off a cliff. relative to how trends were the last 2 years. Trading is still okay, but that's slowing down as well. It's now the core banking. The core banking, particularly loan demand, had started inching up late last year, and at the start of this year, we will likely see these guys discussing that has flattened or started decelerating. There will be some evidence, even though the broader economy and the labor market and the associated purchasing power with that is still very strong. So I can't imagine credit quality going down, but perhaps some early signs on that front is something we could hear from these management teams as well. And then the general outlook for the economy that they are penciling in their outlooks will be very interesting as well.
Okay. Well, that's definitely something to watch that first 2 weeks of earnings season then, because we'll get the read right away. Where is energy in all of this? I distinctly remember from first quarter us talking quite a bit about energy, because you and I both said that it was with the earnings estimates changes that we saw in that quarter, it was going to be one of the best quarters that we could recall in energy, with record free cash flows. And we had never seen the changes in earnings estimates like we were seeing for first quarter. But now second quarter is the quarter that includes the Ukraine war and the spike in energy prices that occurred in the spring. And so what is it looking like for Q2? If Q1 was that good, and it did live up to those expectations, actually, what are they expecting for Q2 with energy?
The outlook is very, very strong for energy. The earnings growth, S&P 500 energy, as of today is 190% year-over-year growth, revenue growth of 36.8%. In fact, S&P 500 earnings growth in Q2 as a whole is solely as a result of the energy sector. If we exclude energy sector, year-over-year growth for the remaining 15 ZAC sectors will be negative, down 5.5%. So very strong earnings growth for energy in Q2 as well as the back half. The trend on the revisions front still remains positive. For 2022 as a whole, quickly, Tracy, since the beginning of the year, energy sector estimates have increased 74%. The magnitude and the stability of positive estimate revisions for the energy sector is something I haven't seen in my long association with the sector. And that I've followed the space for a while. So very impressive, solid outlook for energy.
So if that's seeing the positive revisions, is there any other sector that's also doing that? Because I remember last quarter, for the first quarter, I thought that there were like two other sectors that had some positive earnings revisions going on, but that may not be the case now. I don't know.
So, yes, there are some other areas where there's positive revisions. Transportation has it. More on the airlines front, demand is strong, though, as you know, they are at the receiving end on the fuel front. Construction, believe it or not, has been positive as well. So is autos. But the magnitude of positive revisions isn't really comparable to what we are seeing. So in an academic sense, yes, the revisions trend has been positive in these areas, but nowhere near what we are seeing for energy. And practically everyone else is seeing estimates going down.
And I would assume one of the biggest decliners in the estimates has to be the retail side, right?
Absolutely. Yeah. So we We park Amazon in retail too. Unlike other data vendors that has it in different areas. But retail has had troubles even outside of Amazon. So yes, retail estimates are down. Discretionary estimates are down. We have aerospace, again, a problem with a Boeing issue. Believe it or not, even utilities estimates have come down. So across the board, outside of these a few sectors, estimates have been down for most sectors, including technology and finance.
Okay. How bearish are the analysts being? Because I know we've discussed many times in the past when we're looking at earnings about how the analysts are always kind of late to the party and they're reluctant to lower earnings estimates just based on, hey, we might be going into a recession, that kind of thing, until it actually is happening, and then they lower. So what are we seeing this time around in this quarter? Are they already pricing in, a bigger slowdown this time?
They're not. They are being true to their nature. If you step back from Q2 and take like a bigger picture view, 2022 and then 2023 and 2024, there's no sign of a recession on the horizon. When we aggregate the bottom-up estimates for all of these companies and aggregate it to the sector level, there's positive earnings growth this year, positive earnings growth next year, and beyond that. It's not unusual. Analysts are famous. There is empirical and academic studies on this. They are terrible at forecasting these inflection points in the broader economy. So when the economy is in a steady state environment, then they have a good handle on where estimates for the current quarter or next quarter or the next couple of quarters will be. But if we are on the precipice of a major directional change in the macroeconomy, then they have no handle on that. And they are reliant on management teams in holding their hand and pointing them in the right direction. We are not there yet. So it could be this quarter. It could be the September quarter earnings season where there is this across the board guidance from management teams pointing us in that direction. From current estimates, you could never tell that there is even this possibility in the data.
Yeah, I feel like it's not really the analyst's fault, so to speak, when you have some companies like in retail where they are seeing the conditions changing pretty quickly. And so no analyst is going to be able to pick it up if it's changing like that quickly. And I'm talking about like Target, who reported their earnings, talked about the increase in inventory, and then 3 weeks later came out with another warning, saying it's worse than what we originally said just 3 weeks ago. And now recently the same thing happened with RH, where they had the warning in their earnings, and then not even a month later, we're out with a second warning and a cut to the full year guidance down. So, I mean, if they're seeing these quick changes and having to come out with these extra warnings, then I feel like the analysts sometimes, depending on the industry, is going to be kind of flying blindly.
Absolutely, and it's not possible. If you have a sense of how these forecast models are created and how they operate, it's not possible to embed that kind of an economic breakpoint in those models. These are continuous series of data, and till you see the economy going into or having gone into a downturn, it will not show up in data. And you're absolutely right. The speed at which now things shift has increased enormously. And we saw that with some of those companies you mentioned. And we may see this earnings season. The one thing that makes me a little skeptical on the data front, Tracy, is the outlook for margins. We're all familiar with the supply chain issues and some of the other input cost pressures that have been with us for a while. If you tease out the net margins from current revenue and earnings estimates going forward, like say the next couple of years, it appears that the analysts categorically believe these pressures to be transitory and temporary, and then eventually work themselves out next year. And that's something I believe we can blame them for perhaps being a bit too optimistic on that front. But on the whole, I believe you're right. These are hard things to predict for anyone, including for these analysts who follow these companies.
I was reading an article over the weekend in the Wall Street Journal. They track actively managed mutual funds along with Morningstar. I think they use Morningstar's data. And so they were putting out the half-year update and the 12-month update. And they track 1,342 actively managed mutual funds, and that excludes like the sector funds and the quant funds and the leverage funds, apparently. And only 32 of those were in the green for the prior 12 months. So going back to last summer. And the number one, I know, it's kind of shocking. And the number one out of the list was a value dividend fund. So I guess I shouldn't be surprised because that area has been doing pretty well. But I bring this up because I'm wondering what investors should be looking at this earnings season. Should they be looking at these value income type of stocks? Because in that fund, the number one winner so far in the last 12 months, they owned stocks like Philip Morris and Gilead, Exxon and General Mills and like Total Energies, which is one of the French energy company, but they pay a big dividend. Should we be looking also in these areas? Because it does seem to be working better than obviously, the tech growth type stocks. And it does pay. I looked up a whole bunch of those names, and the highest yield was Philip Morris. Ticker PM, they're at 5%. They also owned British American Tobacco, which is also a really high yield. I forget what it's at, but I've talked about it on the podcast in the past. Exxon was in there. They're at 4%. Gilead now is paying 4.7 dividend yield. Total is at 3.9. And even General Mills, which some of the top funds in that survey owned, that's at 2.7. Should investors be kind of focusing on some of these areas? Some of these are kind of staples and big drug and then energy.
I think one takeaway that all of us will be left with after this downturn is that the excessive fascination with technology and then a few technology companies was perhaps misplaced. And the market is far, far bigger and broader than just a handful of stocks. Absolutely. All long-term investors should have decent amounts of exposure to staples, to energy, even to utilities. And dividends have always been, over the long term, a very important part of the total return in a diversified portfolio. I think energy, there is still some question about the long-term estimates. we have discussed in the past as to how the world as a whole is energy deficient on a supply side. If you look ahead, like beyond the current period, even if there is or is not a recession, beyond the next 12 to 18 months, we are still left with the issue of where hydrocarbons and fossil fuels are going to come from. If we have Russia in the penalty box in the long term, so we have to have these companies incentivized to drill and produce fossil fuels. And that means more earnings, that means more cash flows, that means bigger, growing, and stable dividends. So yes, Exxon, Chevron, depending on somebody's risk profile and tolerance for volatility, even the services players, the Halliburtons and the Schlumbergers of the world. So absolutely.
I feel like I'm reading a list, like a who's who list from the 1970s or the 1980s when I just read that list. I mean, Philip Morris, this is the international division, because then there's Altria as well, which is the
That's
US.
right.
But Philip Morris, that would have been like a 70s and 80s play. Exxon, for sure, in the 70s, one of the best performing stocks of the 1970s, actually. Gilead, I'm pretty sure they were around back then. That sounds familiar to me. General Mills
Sure.
obviously was. I feel like it's like a flashback or something. We're going back to these kind of old style, long-term companies that were winners in their field over all those decades. I mean, they've all won in some respects.
Absolutely.
But now we're looking for those types of winners, I guess.
Yeah, so a diversified portfolio will be one where you will have the Exxons and the Chevrons and the Johnson and Johnsons and the Philip Morrises of the world, alongside some exposure to the Microsofts and the Nvidias of the world. And banking solely on one or the other, if you are consciously and deliberately taking that risk, then all power to you. But if you are just looking for diversification and gains in the long run, not shooting for an immediate home run, then you have to go with these winners that have been survivors and that have a track record and history, and dividends are always and should always be a very important part of the return expectation.
Okay, that's some good advice there. I think a lot of us are learning the hard way during this bear market to not be overweighted in the very hottest sectors always, because it might not always work out how you expect.
That's right. Yeah.
Okay. Any other advice? Anything we should be looking for this earnings season that we haven't covered?
So the revenue picture is very strong, Tracy,
Okay.
and it still remains very strong. Part of that, the reason is that revenues increase with inflation. The problem is more the line items in the context of an income statement. So margins have been under pressure. And what to look for is how these companies frame the outlook for margins. Do they see that as a temporary issue that perhaps lasts a quarter or two, or something that they see has structurally changed in their business, where expenses have increased? Another item that we tend to overlook is that we are coming off of a very long period of very low interest rates, which also benefited margins. That's not going to show up in the Q2 results, but in the long run, I feel analysts are giving less credit to the fact that in the future, interest rates will be higher, and that should have a negative impact on margins as well.
Okay. And what do you see about the beat rate, the actual surprise rate this quarter? Will it be similar to what we've been seeing, but even with all this uncertainty and the analysts, lowering some estimates going into this quarter already, what are the odds looking like for that?
So historically, around 70% of companies beat their estimates, a little less on the top line, a little more on the bottom line. These ratios increased significantly during the pandemic because analysts were a little more cautious, and it was hard for them to handicap the numbers. If we are heading into a period where the economy is slowing, when there are troubles ahead, I would expect those beat rates to come down, and for many companies to be missing estimates, because things in the macroeconomy and in business are changing a lot faster than it's been possible for analysts to adjust the estimates for. So if the bearish views of the economy are correct, then we should expect many companies to miss estimates, as opposed to what the trend has been over the last 2 years.
Okay. That's definitely something to watch. A lot of the trader types are always watching that beat or miss type of thing. So that's a big issue. Yeah. All right. Well, it's about to get started here in the next week on this earnings season. So it's going to be another really interesting one, I have a feeling. And a lot of people are going to be tuning in for those guidance outlooks and all of that to really see what's going on out there. Yeah. Okay, let me recap some of the stocks we've talked about on this episode. So we did mention some of the energies. So Exxon, XOM, Chevron, CVX, Halliburton is HAL, Schlumberger is SLB. Those last two are on the services side. All of those stocks have come down quite a bit off of their recent highs, some as much as 20 or 30%. So could be a buying opportunity in some of those names. We also mentioned the back to the 70s and 80s stocks. Philip Morris, PM is that ticker. That's the international one with the 5% yield. I said Exxon already. Gilead is GILD. They're trading with a dividend of 4.7% and only at 9 times earnings. General Mills, they just had a good earnings report, so they've already gotten theirs out of the way. GIS is the ticker there. And the big winner so far in that Wall Street Journal Morningstar survey, Total Energies, TTE is the ticker there with a 3.9% dividend. And that's the French large oil integrated company, only trading at 4.5 times its forward earnings here, with these record earnings expected again this quarter in the energy side. So as always, you want to be sure to subscribe so that you're getting all of our podcasts, because there is a lot going on. You can get us on SoundCloud as always, and Apple Podcasts. We're on Spotify, Amazon Music, just about anywhere you can get podcasts. You can get us, and be sure to get the Value Investor podcast as well. I do that one every week, but be sure to get us somewhere, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.